Hi, so in this video I'm going to explain how a limited company director can borrow from 19 to 25% more for a residential mortgage. So first of all, my name is Raj Boughan and I'm a mortgage and life insurance expert specifically for limited company directors. So what am I talking about, 19 to 25%? Why, that's a random set of numbers. That's actually to do with the corporation tax rate in the UK. You get charged between 19 minimum and up to a maximum of 25% or somewhere in between. I'm not an accountant. I'm not going to explain how it works. I don't even understand it fully with the rates in between, but speak to your accountant if you're unsure. So what I'm going to start with is explain how do mortgage lenders assess a company director for a residential mortgage. Just to be clear here, I'm talking about a residential mortgage where you're going to move into the property, not when it's for a buy-to-let. It's a completely different way of looking at things. They look at the rental income. That's going to be your projected rental income, not your personal income. Different way of working it out. So most lenders, I'd say, I don't have an exact percentage, but maybe 85% of lenders will look at your salary that you've paid yourself and any dividends. They're treated equally. And they will typically average it over 2 years. So for example, if you made 40,000 in year one, and in year two, you made 50,000, the average of that is easy. 45, simple. So that's what they use your income, just as if you had a salary of 45,000. However, the other 15% of lenders will use salary and the net profit of your company, limited company, or your share of the net profit, I should say. In some cases, or a lot of cases, that net profit figure is higher than the dividend, so your income can be higher, which means you can borrow more. Brilliant. So of that 15% of lenders, some of them, and there's probably only about 5 of them, will use the before corporation tax number, which is going to be higher. And how much higher? Well, depends on how much corporation tax you pay. It could be minimum 19 to 25% more. So let me give you an example of what I'm talking about. So here is a set of company accounts. Obviously I've kept the information, it's not saying whose name, accounts it is. I want to show you a few different numbers, and these are the main numbers I look at. I need to know to work out how much you can borrow. First thing we've got down here, which is not always on this page, is the dividends. So you can see in 2024, it's 81,000 paid, and obviously 55.5. It's not showing the salary on this page, but I can just tell you it's approximately 12.5 grand. So if you take those two figures together, if my maths is right, it's 136 or so. And then half that is brain work. 68 plus 12 is about 8. So it's about 80k is what that lender, most lenders would take as this person's income. And in this scenario, the income is going up. You can see dividends are up, profit is up, even turnover's up, gross profit is up, etc. So that's fine, they'll average it. A few, not many, but occasionally a lender, there's very few, would just take the latest year only, which is good. But the majority will average. Nearly every lender, if these numbers were the other way around, would not average and they would take the lower figure. Okay, now let's focus on the 15 or so % of lenders that will take the net profit, because you can see that the profit here after tax is significantly higher than the dividends, which means that this customer can borrow more money. I'm not going to go through the figures, but you can see they can borrow significantly more already. However, to borrow even beyond that, you can see the profit before tax again is even higher. So if we go to the 4 or 5 lenders that use that method, then that's how this client can borrow another 19 to 25% more, just simply by using the pre-tax method. Now, because there's only 4 or 5 lenders, it might be that there's not much choice. There might be that they can get what they want anyway using one of the other methods, and maybe they can get a better rate, or maybe there's some criteria issue that lender won't accept. But in some scenarios, it's a fantastic way of being able to borrow that bit more, and it might just get you over the line and get you that dream house that you need.